Now, another investment vehicle is bonds. I don't know that I'm going to take the time. I think if we get to the end, I might, but bonds are not going to give you the same return as if you invest in the stock market. All right. So typically, bonds, let me just explain it like this. Bonds is a bond is a debt. So basically, governments, cities, counties, they will float bonds. In other words, they will loan people the money, or you will loan money to the government, and then they'll give you a certificate, a bond, and then so maybe they're paying 3%, 4%, maybe 5. It just depends. Some are tax free, so you know some people. I mean, obviously, people invest in these things. All right, highways, new schools. A lot of times, I mean, listen, most counties do not handle their money well. They do not have any cash on hand. So it comes time to improve the schools or they need money for projects. They have to float a bond and borrow money from the public. I mean, that's kind of sad, isn't it? Because they're not saving money. They tend to spend or overspend their money. All right. And most do not have a rainy day fund. And if they do, it's not that big. All right. But a bond is a debt, and it's an instrument by which the company or the government owes you money. Now, your return is the fluctuation in price and the interest rate paid. So, you'll get an interest rate or so on. But it's hard to do well with a single bond purchased. Once again, we're trying to stay away from singles, like single stocks, single bonds. And there are treasury bonds, U.S. government savings bonds, and all that. And I know people buy these things, but they're typically very, very low return. So we're going to stay away from those things. That's just not something we're really interested in. Okay. Now, mutual funds, that's where we want to go. And that's where we want to spend our little bit of our time in. A mutual fund is, let's suppose that I was a fund manager and in the class, I got all of you to invest in it. You would mutually invest in the fund that I was overseeing. All right, that's all a mutual fund is. It's just a bunch of people pooling their money into one fund. All right. Now, before I go any further, let me just say this. When it comes time to invest, it's not a bad idea to have, you're going to have an account set up. So you might go to an investor. Here's the deal. There are some people, and I've talked to people, it's like unless you have $600,000, they don't want to talk to you. So it's a little more challenging for the small investor. However, if you take a job at Harris Teeter, Kroger, whatever, or just about anywhere now, they'll enroll you in a savings plan, in a mutual fund. So you'll have a 401k account or something, and they'll put you into a mutual fund. Now, in this day and age, a lot of people have gone this way, which is not bad. And let's say y'all are not quite 20, but we're in the year 2020. So let's say you're going to retire in 40 years. All right. So they would put you in a fund and they would choose investments. The fund would, depending on when you're going to retire. So your fund would probably be called something like the 2060 fund or the 2065 fund. In other words, investments, the fund manager will make investments and pick investments or stocks based on their knowledge of the market and what they think will best suit you 40 years down the road. Now, they'll make changes as time goes on because at some point, you're within 10 years or whatever of retiring. Okay, so, and then, in other words, that takes all the thinking out. In fact, most of you, I mean, look, 90, I don't know, 98% of the people, they don't want to fool with following the market and all this and keeping up, and they'll just let the fund manager take care of it. But you can give them a little bit of idea of how you want to be invested. We'll get to that in just a moment, all right? But once again, a mutual fund is an investment vehicle made up of a pool of money collected from many investors, all right? And once again, I'm going to invest. I'm going to encourage you, invest monthly, all right? Start early, and even if $50 a month, that's fine. I mean, that'll give you what, $600 a year. Now, if you go back to page 40, I know it's not $2,000 a year, but it's better than nothing. All right, we want to get started, and the earlier, the better. All right. Another thing on page 169, portfolio managers manage the pool or fund, and of course, they're attempting to increase the value of the fund. Um, they've got to make money too. So once again, they're trying to increase the value. All right. At the bottom of the page, your return comes as the value of the fund is increased. Right? Just like a stock. If the stock goes up, the value goes up. You make money. It's mutual fund the same way. If the pool goes up, then if the various investments go up, then the fund's worth more, and you know the value your value goes up too. All right, so it's all about trying to make money. Now on page 170, on mutual funds. Once again, it's an opportunity to give small investors access to professionally managed, diversified portfolios of stocks, bonds, and other securities. So the mutual funds, they invest in a lot of things. All right. But now listen, you can be in a mutual fund and invest only in stocks. And I'm going to show you how to do that. All right. So here we go. They're long-term investments. Once again, we're in the market. This is not 5 years or less. This is 5 years or more. This is down the road. So look at the chart there. You want to split your money up. And when you open up your 401k or whatever, you can diversify your money this way. You can tell the fund manager, however the communication is done, through an email. I don't know, because funds are different. You could tell them you want to put 25% of the money in mid caps. That is growth stocks. All right. You can see that on the chart. You tell them you want to put 25 in large cap. That's growth and income. All right. Now, large cap stocks are calmer. Their stocks don't shoot up. All right. These are mature companies. They've been around. Some people call them blue chip stocks. All right. And then there's 25% in international stocks, global funds, whatever. You want to be invested outside the U.S. 25% of your money. Okay. And then you want 25% in aggressive growth or small cap. So these are smaller companies with great potential, and they go up and down. All right. And so, but that's okay. You want that. They're exciting, and sometimes they're depressing because they go down. That's okay. We're trying to be diversified. So that's how we want to invest our money in a mutual fund. We want to go 25, 25, 25, 25%, and then you don't worry about it. And that's going to give you probably the best chance of getting the best return possible on your money.